It's worse than 2008. I'm your host, Steve Van Metre, and thanks for joining me today. And China's days from collapse as a massive currency intervention is imminent. Let's over to Bloomberg, where we picked today's story up as the yuan falls to its weakest since 2008 on signs that PBOC is easing grip. The onshore yuan fell to the weakest level against the dollar since the global financial crisis in 2008. Amid an incessant advance in the greenback and speculation, China is toning down support for its local currency. And this is important because you think back, what was 2008? It was a global dollar shortage. And of course, what ended up happening, China and other countries would be forced to devalue. And all of a sudden, all the wheels come off the bus. We're seeing a replay of it right now before your eyes. The onshore yuan has fallen more than 4% against the dollar this month and is on track for the worst annual loss since 1994. Beijing, on the other hand, is keeping an accommodative stance amid rising risk of deflation as demand slumps under the weight of the ongoing property crisis and COVID restrictions. But there's more problems coming for China. This headline from the Wall Street Journal is more trouble for China's export juggernaut, and China has become more dependent on exports for growth than it has in years, but the export boom is starting to lose steam. Now, I want you to be thinking when we talk about exports, where are they going? To the United States. So I want you to be thinking as we go through this, what's going on in the U.S. economy and how that's going to affect China's. China's September official purchasing managers indexes released on today were a mixed bag. The manufacturing gauge ticked up unexpectedly to 50.1, meaning it was unchanged. There was no change in the manufacturing sector, edging above the 50-point mark, separating expansion from contraction for the first time since June. But the services sector dipped back into contraction for the first time since May, when Shanghai's fierce lockdown was at its height. Meanwhile, the Caixin privately compiled manufacturing PMI, which focuses more on private and export-oriented firms, weakened further and is heading into contraction. And perhaps most worrying from Beijing's perspective, both the official and Caixin factory indexes show declines in new or export orders deepening. And that is the story that we're going to focus on in today's show, is what's going on in the U.S. economy and how our slowdown here is going to take China's economy down. And they're already starting to feel those effects. That's one of the reasons their currency is weakening and why things are just getting so bad there. More concerning is a weakness in exports because that sector has been one of China's few bright spots over the past year and a critical source of jobs, key jobs, as the housing market and services sector growth has shriveled. Employment in industry as opposed to services grew in 2020 and 2021 for the first time since 2012. In significant part due to the export boom. Net exports of goods and services accounted for 25% and 21% of China's economic growth in 2020 and 2021 respectively, the highest total since 1997. This year, things have gotten even more extreme. Net exports accounted for 36% of growth in the first 6 months of the year. And here's the key point, is China is becoming more and more dependent on exports for its economy. Now, you think in China's perspective, they're trying to build domestic demand, but what's happened now is they become even more addicted to the global economy, needing the global economy to do well in order to drive their export growth. So if the global economy starts to slow, what does that mean for China? You're right, collapse. But don't bet. China's central bank warns against yuan speculation as they go after the weakening yuan. The PBOC statement, which is a requirement for banks to maintain stability in the foreign exchange market, is, quote, verbal guidance against the recent rapid depreciation of the currency, according to Goldman Sachs. Now, what this means, what this is being interpreted as, is that the PBOC is telling the banks that, hey, look, we're about to give you the signal, and when we do, we're going to put these speculators out of business, and we're going to bring the yuan back up. And the way we're going to do that is you're going to dump dollars onto the market and buy yuan. That's the plan. And so what this is a warning shot to speculators to get out of those short trades and let the yuan appreciate, bring the dollar back down. Of course, that would bring yields up. If that doesn't play out, well, it's going to be Armageddon. But one thing that shouldn't blow up if China goes all in on trying to restore the value of its currency is your portfolio. I'll put a link up here to Portfolio Shield and description below, because now let's talk about the U.S. and China's addiction to those exports. Because if the U.S. is slowing down, then China has no way to stop it. Here you can see with this headline that Nike falls amid eroding profitability and inventory buildup, suggesting there are big problems in the U.S. as Nike in particular struggled to resolve logistics issues stemming from port congestion and shipping logjams. Overall inventory rose a whopping 44% in the most recent quarter compared to the prior year. The amount of merchandise in transit also spiked, as we've suggested, even though executives noted that shipping times are improving. And we're taking decisive action to clear excess inventory, according to the CFO. And he is expected to have a transitory impact on gross margins in the fiscal year, but this cost will far outweighed by the benefit of clearing marketplace capacity. So we're seeing multiple things here. We're seeing massive inventory building at the same time, signs of deflation, as of course Nike is going to have to aggressively mark down this massive inventory. And what is that going to mean for their profits? Well, it means that they're headed down too. And all that, what we'll see is they're going to lead to more unemployment claims as the manufacturing sector shifts downward to absorb all of these higher inventory levels. Let's take a look at this chart. Here we've got the Philly Fed Current New Orders Diffusion Index, one of our favorite charts to look at. Now we're going to overlay the retailer's inventory in red. And I'm putting the retailer's inventory on a year-over-year rate of change. And what we want to note is not only are retailer inventories at record all-time high, but notice the rate of change. Normally what you see is new order growth starts to slow down and retailers are trimming inventory, and you see that over and over again. This time you see new orders growth is falling against rising inventory, and what that's telling us is that new order demand is going to outright plummet in effort to get rid of these inventories. And what does that mean for China's economy, who right now is heavily dependent on its exports to the U.S.? It means big trouble. But it's not just Nike that is signaling the warning flags, there's others. As CarMax's huge earnings miss points to trouble ahead for new car market, the resale market often indicates where new car demand is headed, and CarMax said vehicle sales dropped in the first 3 months, ending October 31st. Both consumers and wholesalers, they all buy from CarMax, pulled back, the company said. So again, here we see more indications of weaker U.S. demand. And it's not just in the apparel market, it's not just in the car market. We're also hearing from the big tech companies that they think things are slowing down in a big way. As Metre to cut headcount for the first time in history, slashed budgets across all teams. In what would be the first major budget cut since the founding of Facebook in 2004, Zuckerberg said the company will freeze hiring and restructure some teams to trim expenses and realign priorities. Metre will likely be smaller in 2023 than it was this year. And now what does that translate to is, of course, inflation. So we're seeing a broad-based slowdown in the U.S. China has nothing it can do to stop it, can't stop its currency depreciation, and is telling us that even if they do dump dollars onto the global economy, that their currency is probably still going to fall, leaving their final move is a devaluation. But will the Fed capitulate? Well, maybe not when we look at today's data. The Fed's preferred gauge of inflation shows that inflation accelerated even more than expected in August, putting calls for a rate hike even higher in November. The Personal Consumption Expenditures Price Index, excluding food and energy, or the core PCE, rose 0.6% for the month after being flat in July. That was faster than 0.5% predicted. On a year-over-year basis, the core PCE increased 4.9%, more than the 4.7 estimate, and up from 4.7 last month. Including gas and energy, the headline PCE increased 0.3% in August, compared with a decline of 0.1% in July. It rose even with a sharp decline in gas prices, and that is a huge problem because personal incomes, while they did increase 0.3% in August, the same as July, spending, thanks to credit cards, was up 0.4% after declining 0.2% the month before. After-tax incomes increases 0.1% after rising 0.5% the previous month, while inflation-adjusted spending rose a scant 0.1%. So we're seeing here in the data all these signs that point to further rate hikes. And what are the Fed speakers saying? Well, you got it, more hikes. Fed officials reinforce rate hike calls and say markets are starting to get the message as stock prices head lower. We're determined to get the right level of policy rate in order to put meaningful downward pressure on inflation here. And of course, that's the key from the Fed, is they're looking to be aggressive here. But is inflation coming down? Will the Fed be on the wrong side of the trade? Well, for that, let's head over to the desk of our chief strategist, Jeff Snyder, who writes in his daily that inflation expectations are tumbling. He said if there's indeed a third wave of deflation breaking over the global marketplace, as widely indicated in markets and curves, you'd expect inflation expectations to ignore, say, Germany's huge consumer price acceleration or other rate affirming data. The TIPS break-even, or Treasury inflation-protected securities break-even, traded exactly the way during today's eye-opening session. Falling inflation break-evens are again outpacing the decline in oil, which is typically the defining catalyst for CPIs and therefore CPI protection. And here we can see in this chart with the 5-year TIPS break-evens in red against crude oil prices, all the signs point that inflation is coming down. Now, if you'd like to know more about what Jeff Snyder says, our energy and materials expert Tracy Schuchart and I, well, we've gone paid, but for a limited time through October 9th, there's a special, not only 50% discount, but lifetime renewals for 50%. So next year or next month you sign up, you still hold that discount. MarketsInsiderPro.com. Get it before it's gone. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.